Good morning, everyone. My name is Rob, and with me is Thomas, Emily, George, and Zach. We are initiating coverage on U.S. home builder PulteGroup with a bold recommendation. Our blended valuation yields a target price of $53 with an upside of 23% and a downside of 15%. Our peers include Lennar, D.R. Horton, KB Homes, Meritage Homes, and Toll Brothers. Four catalysts drive our recommendation. While we recognize PulteGroup's capacity to create shareholder value and their diversified market position, a neutral valuation and sensitivity to economic headwinds indicate limited upside, confirming our assessment. I'll now turn it over to Emily for an overview of the business.
Thanks, Rob. PHM operates through 6 brand names serving a variety of customers at different price points. They categorize their customers based on first-time buyers, move-up, and active adults. And as you can see in the middle chart, PHM serves all of their customers. However, we expect them to continue focusing specifically on first-time buyers. Land is an essential lifeline to the company. As of 2022, 48% of their land was optioned. We expect this percentage to increase as they align further with their peers and lighten their balance sheet. I'll now hand it over to George to talk about how the company is diversified in growth markets.
Thanks, Emily. PHM has a wide geographic reach in the United States with 6 regions across the country. However, they derive 39% of their revenue from only 2 states, Texas and Florida. Now, PHM is one of the only operative builders with this broad positioning across high-demand markets. They're the 3rd most competitive home builder with a significant presence in 33 of the 50 largest metropolitan markets, as you can see by the gray bar in the leftmost graph. Also, at the same time, PHM has been increasing their single-family market share, or the market as a whole has been increasing from 40 to 60% for operative builders in the single-family market. We anticipate that PHM is well-positioned to continue capturing this growth in high-demand areas and expand into locales adjacent to their existing footprint. I will now speak to the economic headwinds that are facing PHM. While they are well-positioned geographically, PHM and the industry as a whole are tied to macroeconomic conditions. Factors such as inflation and interest rates have risen construction costs and damaged consumer confidence over the last year. This has caused an increase in cancellation rates, jumping 10 and 18% for PHM and the industry as a whole, respectively. Because of these strong ties to market trends, we anticipate that PHM will continue forward in this direction, tied with the market into uncertain and possibly choppy economic territory. I will now pass it over to Rob to speak to the inverted yield curve and operating leverage.
Thanks, George. As George mentioned, the home building industry is notably dependent on macroeconomic conditions. An inverted yield curve signals the potential for a recession as the Fed continues to use rate hikes as a means to fight inflation. Rising rates decrease the demand for new homes as the cost of borrowing for home buyers increase. For example, our statistical analysis indicate that for every % increase in the federal funds rate, we should expect a $508 million decline in revenue in the following year. Furthermore, PHM, PHM is more reliant on fixed costs in order to generate revenue, and thus have a higher operating leverage when compared to their peers. So for PHM, their operating leverage is 2.1, which implies that for every % increase or % decrease in revenue, their operating income should decline by 2.1%, which is 14.3% more sensitive than peers. I'll now speak to the value creation aspect of our hold recommendation. PHM has consistently outperformed peers with respect to returning on investment projects. This is evident in our ROIC versus WACC spread. Furthermore, PHM has prioritized returning value to shareholders, as seen in 2022, with a 10th consecutive increase in dividend per share and a 10% repurchase of all shares outstanding, totaling to $1.2 billion given back to shareholders. We expect outperformance across the board with profitability to continue for the next 4 years as PHM cements its position as a reliable source of cash flow for investors. I'll now hand it over to Thomas for a discussion of valuation.
Thanks, Robert. We use 6 rigorous valuation models to derive our 12-month target price range of $44 to $65. In this calculation, we use the dividend discount model, discounted cash flow model, earnings power value model, public comparables model, residual income model, and discounted cash flow model with EV to EBITDA multiple. As you can see in the valuation football field on the left, we have PHM's 52-week range, as well as the ranges yielded from each valuation model. The bottom light blue bar indicates our weighted blended valuation range of $44 to $65. Furthermore, our range is affirmed by 51% of 10 million Monte Carlo simulations, furthering our hold recommendation. We conducted sensitivity analysis for two of our highest weighted models. In the dividend discount model, we varied the sustainable growth rate and the cost of equity. And in the discounted cash flow model, we varied the weighted average cost of capital and the terminal growth rate. We did this to see how different changes in the company affected the two prices in our highest weighted models. I'll now allow Zach to discuss ESG initiatives for PHM.
Thank you, Thomas. As you can see on the table, we compared PHM to its peers using various ESG metrics. PHM's ESG risk is only marginally better, if not average, when compared. The company's environmental impact historically has benefited from building more sustainable homes and using more energy-efficient appliances and techniques. This can be seen by a decrease in home energy rating scores, where lower scores are more favorable. However, an increase in total greenhouse gas emissions and the lack of forward-looking initiatives, such as a climate change policy, dampen PHM's environmental score. If the addition of such initiatives would reduce PHM's future ESG risk. From a social perspective, PHM received numerous workplace awards in 2021. The company also has several social initiatives, such as a diversity, equity, and inclusion board. However, PHM still falls short in minority representation in non-manager and manager positions. We use the ISS quality score to further evaluate PHM's governance. The audit score of 6 is largely due to the issuance of a critical audit matter over the past 4 years. The low risk associated with compensation can be attributed to the low CEO pay ratio to the average employee and the implementation of a clawback policy. The high risk with shareholder rights is due to the current shareholder rights plan. This plan contains 500,000 authorized but not yet issued preferred shares. Finally, the board structure is composed of 10 directors, 9 of whom are independent, but only 2 are female. The directors have an age limit of 75, but no term limits. In summary, the mixed environmental, social, and governance risks associated with PHM support our whole recommendation. Now, Emily will continue with investment risks.
Thanks, Zach. PHM acquired Innovative Construction Group in 2020 for $104 million in Jacksonville, Florida. The company is at risk for not realizing the synergistic benefits from the acquisition of a shortened build cycle in the Florida region. Next, we use the PESTEL framework to examine and identify external risks that the company is facing. For political, an 18% tariff on Canadian lumber increases the price of a new house by about $14,300. The reduction in the tariff to 8.6% still increases the price of a new house by about $7,000. Economic risks pose a threat to the company because it can prolong their build cycle, stunt customer demand, and hinder the company's growth. As George mentioned earlier, 39% of their revenue in 2022 came from 2 states alone, Florida and Texas. The company can work to mitigate the extreme climate risk by further diversifying their revenue geographically. So we use this risk matrix to categorize both the internal and external risks that the company is facing based on probability and impact. As you can see in the top right corner of the matrix, we believe economic risks pose the biggest threat to the company. I'll now pass it back to Rob to close us out.
Thanks, Emily. To sum up our presentation, we issue a hold recommendation based on 4 key drivers, namely value creation, a diversified market position, neutral valuation, and sensitivity to economic headwinds. We thank you for your time, and we open the floor to questions.
Thank you, Team C.
Can you talk a little bit about how Pulte is managing the rising costs of goods and your projection for lower demand versus competitors?
Sure. So actually, interestingly enough, if I understand this question correctly, we actually ran a regression including a construction index, construction cost index, and it actually positively predicts revenue. And so what this implies is that PHM is able to pass on some of their increases in revenue costs to their customers, meaning that they're actually in some way benefiting from this.
Yeah, and I'll tag on to that. In the most recent annual reports, they mentioned that they were able to pass on most of those costs in the first half of 2022, But depending on what they mentioned that depending on what happens the next year, that may not be quite as feasible. They might take more of a loss, depending on the economic outlook. But for the most part, they did say they were able to pass most of those costs on to consumers.
Better relative to competitors or in line with competitors or not sure?
We would say most likely better than competitors.
And also, going back on what George said, for those costs that they are not able to make up in this next year and pass on to consumers, they've identified that and they've already said that in 2023, they're planning on significantly cutting their expenses to kind of position the company for that. So we don't really expect to see any growth or anything, just kind of stabilization within the next year of the company.
Can I ask you a couple of questions about your valuation models? Can we go
Yes.
to that? DCF? Cost of equity capital is, what did you assume?
Yes, sir. So here is the DCF and then our cost of weighted average cost of capital inputs. So we had the 10-year T-bill 9.3 for the risk-free rate, or no, I'm sorry, I misspoke.
As a component.
Yeah. Okay, but then we had our weight and our cost of equity and our weight and our cost of debt. So that's how we derived our weighted average cost of capital.
And your long-term growth rate?
So our long-term growth rate was varied based on the 3 different cases. So for our bear case, we did 2%. For the base case, we did 3%. And for the bull case, we did 4%.
And what were your weightings again on these various models, the 6 models?
So the weighting for the dividend discount and the discounted cash flow with the 5-year exit and the earnings power value was 20%.
Each?
Yes, sir, 20% each. And then the other ones were a mix of 10 and 15%.
Thanks.
How do you think about the capital intensity of, I guess, Pulte seems like a lot of CapEx and spend on inventory, and wondering how do you view the capital intensity here? Also, relatively fragmented market, so curious to get your thoughts there.
Sure. So I can talk a little bit on the capital expenditure side. So this past year, Pulte Group invested $4.5 billion in land spend. However, they're decreasing to $3.3 billion for next year. So that's a little bit of foresight there.
And further about the land, how they're doing that. So, and how we mentioned earlier that how they're cutting their cost in 2023. One way they're doing this is they're not going to be taking on that much more land. They're going to continue using up all of the owned land that they have. And this will, again, in the future year, probably 2024, then they can start taking on more options and better position themselves for the option to own land.
Yeah, and relative to competitors, they're a little bit below where their 2 largest competitors, DHI and LEN, sit. They sit above 50%. Right now, I think in the graph that was back, but we don't need to get to it, but earlier in the presentation, they're sitting at 48%. So they're, as Emily mentioned earlier, we anticipate them to rise, and having options creates more flexibility in CapEx. So
I think if I heard it right, you did sort of a sensitivity in terms of how sensitive this company was to interest rates versus some of their competitors. If I heard that right, could you maybe just expand on that a little bit, how you went about that exercise?
Sure. So we performed a time series regression analysis, controlling for certain variables such as home starts, cost of construction index, and prior revenue, lag revenue. And that model explained about 95% of the variance in the revenue of Pulte Group. And that particular coefficient for that rate of change was significant in the 99% confidence level.
And you were sensitizing against interest rates, is that right?
Correct. Fed funds rate for one of our models. And then we also developed another model for the 30-year mortgage rate.
So where did they rank versus competitors in terms of how sensitive they were? Were they more or less sensitive?
Slightly less sensitive.
Can you talk about the mix of their business and profitability per mix? So it seems like you're saying that the economic impact of higher rates is a minus, but some of those move up and some of the adult population are going to have most of the money and not borrow. So wouldn't it make sense to move the business from some of the first time to some of the older buyers?
Can you please repeat the question a little bit?
Can you talk about the profitability mix of the 3 different types of buyers, move up, adult, and first time? The fact that one of the groups is really impacted the first time, but the older groups are not as impacted by interest rates.
Yes, so the company is actually the largest provider for active adults, so they could easily take advantage of that and grow further into the active adult community, like retirement communities, if they wanted to. I don't see. To me, I think that's an advantage for them to overcome that. If they think that continuing focusing on the first-time buyers would kind of hinder their company growth, but they did say in their 2022 report that they do plan to focusing on first-time buyers in the next year.
Is the profitability there? Is that why would they focus on something if the profitability or the headwind is larger?
Well, I think first-time buyers also like present the potential for like future purchases when they move up and become active adults. But it's just, it has been their trend over from 2018 to 2022. And so as Emily mentioned, that's what they indicated as their focus. And it certainly could be a minus in the coming years with an increased interest rates. And I think it further emphasizes our whole recommendation that there's a mix in areas where of their market where they may not be as impacted versus where they've been growing in first-time buyers.
So you don't know the margin between the 3 different areas, like the profitability by type.
It's in the middle graph right here, based on profitability. So right now, Move Up has the highest profitability for the company right now.
What's the closings?
Oh, wait.
Yes, sir, but more closings equals more revenue, which I don't know. We don't have the specific numbers on the margins for each of those, but generally, Move Up and active adults are buying bigger homes, more expensive homes in higher value land areas. So,
Thanks.
What's the economics of land purchases look like? Or sorry, the options on land, how does that work?
So basically, when you like the benefit of optioning versus owning, or
How does it work in terms of what's the cost? Do they have to pay for that option on the land? And how expensive is that?
so basically, when you option a land, you're entering into a contractual agreement. You pay a given cost significantly less than if you own the land. And so basically, you have a decision by the time the contract states when it's up if you want to develop the land, or you've done your research, you've done more, and you realize, nope, this area is not as great a location as others, and you just walk away from it. So you don't have that liability weighing you down as if you own the land.
very similar to just like options traded in the market. You have the right but not the obligation to purchase.
What are your thoughts on the company's historical use of cash for dividend payouts and share repurchases, and whether you think that was good use of cash, or whether in the future it could go to other things, and how that might impact the stock price?
Sure. So overall, Pulte Group is clearly outperforming its peers with respect to capital deployment, especially in the sense of dividend payments and share purchases. So if we think about the average share price for the purchases in 2022, it was $44. The current price is $53. So it indicates a 20% upside on that invested capital. Very, very well spent for sure. And we're looking forward to more authorization of those repurchases in the future.
Last question.
I might have missed it. How does their dividend yield compare with their competitors?
Their dividend yield is approximately on par with their competitors at about 1.1%.
Thank you very much.